Hello and welcome back to The Note. The question for today is, when is good news bad news? We had some clear, very good news on the US economy today. The US non-manufacturing ISM survey of supply managers was as strong as it's been in about a decade. Plainly, the service sector is doing well, even if the manufacturing sector still isn't so exciting. That led to a very clear strengthening of the dollar. It led to higher bond yields, as you can see in the case of the 2-year yield. It's up to its highest level in more than 4 years. But you also saw a sell-off, a slight sell-off in the stock market. Now, you can see clearly enough why that might be. If you've got this kind of economic strength, then the chances of a rate rise by the Federal Reserve next month plainly rise, and that in aggregate is bad for stocks. Now, if we take a look at this next chart, you can see the red line there is the implied probability of a rate rise next month as derived by Bloomberg from the Fed Funds futures market. And you can see it's got right the way back up to 60%. However, the S&P has really not sold off that much in response to that. And if you look at the rest of the year, you can see the relationship between these two lines isn't as clear as you would think. While the stock market sold off in August, you saw the implied chances of a rate rise also fall because market participants bet, perhaps correctly, that a falling market would mean that the Fed wouldn't have the guts to go through with a rate rise. But as of October, when we had a very bad employment report, you can see that that led to a sharp fall in rate expectations, and that seems to have been the trigger for the very dramatic rise we've had in stocks since then. What is intriguing is that today we are back up to 60% chance of a rate rise, and yet it hasn't had that big of an impact on the stock market. Does that mean that good news might almost still be good news? Well, we will have to wait and see, evidently. I think there are two potential explanations for this. One is that the Federal Reserve, after much kicking and screaming, has managed to prepare the market for a rate rise. The other is that people are now far too complacent about a rate rise and the risks it would bring of turmoil in the bond market. We will have to wait and see. Next up on Friday, we have non-farm payroll data.